My name's Ashley Taggart. I'm one of the owning partners here of Neave law firm who's hosting tonight's event. I'd like to welcome you all to our beautiful office in Auckland. I run the National Commercial Property team for Neave. We're a law firm of 154 years of age, the second oldest law firm in New Zealand, 4 offices throughout New Zealand, Auckland, Wellington, Queenstown and Christchurch. We've had a long association with the foreign business community through mainly our immigration practice led by Mark Williams and Rachel Mason. Dealt with a lot of migrant investors over the last 20 years, and 6 years ago started a specialty China business team led by Haijia King, who several of you have no doubt met, and that practice has grown significantly. We are very keen observers of the relationship between China and New Zealand and fans of a close association between the two. I'd like to thank our co-hosts tonight, Catalist, Colin, David Meyer and Grant Thornton as well. Great to have you all here and lovely to be associated with your businesses. So thank you again for coming, and I'll hand over to Michaela.
Greetings all. I'm going to echo some of the sentiments that Ashley just shared. Just firstly, thank you for joining Mia and our co-host Neave, and of course Grant Thornton. And our most important is that our member Catalist, which is New Zealand's first licensed stock exchange for medium and small sized businesses. I'm going to keep this very brief, but I just thought it's worth noting that why I think this is such an important subject, specifically in New Zealand context, is migrant investors often come to this country and want exposure to the top performing companies that contribute to New Zealand's GDP. And typically you can go to stock exchange. And New Zealand is an unusual jurisdiction in that most of our most successful companies are privately held with a few exceptions. And so Catalist comes in as a real mitigation against this problem, and it provides deal flow, it provides access to wonderful companies that otherwise would be hard to access. So I'll leave it to the speakers to impart their knowledge, but essentially we're going to hear from Colin first, talking about Catalist from an investment perspective. We'll hear from Neave around the legal implications, and Grant Thornton around the tax implications around the equity plans. So welcome, Colin.
Thank you very much. I need a...
You do, sorry.
Thank you very much, and thank you to Neave for hosting this evening, and for Mia for arranging the evening. Do I get to move these on? Okay, so tonight we're going to talk a little bit about liquidity for smaller businesses, what it is and why it actually might be useful to smaller businesses. To give you some context though, what do I mean by smaller businesses? So here we're talking about businesses that would normally be considered too small to list on a stock exchange. So there's no hard and fast rule for this, and if you talk to NZX, they'll tell you that any business can list on their exchange as long as they're at least 10 million in valuation. But really, most people in the market would consider about 100 million in market capitalisation to be the bottom of end when it's sensible to list on a traditional stock exchange. As Michaela was saying, a large number, in fact 97% of the businesses in New Zealand are smaller than that at the moment. And there's a few problems which I'm going to talk about which we're helping to solve. So what I'll start with what are those problems and why does liquidity help for those problems? And then I'll talk a little bit about 2 examples of how Catalist in particular, but how a stock exchange that provides ability to trade shares or other types of securities can actually help businesses. So one of those is an employee share scheme where employees are able to obtain shares and investments in your business. And the second is a more traditional, like a mini IPO, where we'll talk a bit about how your business can list. Moe will then talk a little bit about the tax implications of the employee share schemes, and Claire will talk a little bit about the legal implications of a mini IPO. Oh. So what are the problems that we're trying to solve for smaller businesses? Well, who here runs a business that they would class as being under 100 million in market capitalisation. Do we have a lot of business owners here? Yep. And is there anyone of that group who hasn't come across at least one of these problems? Yep. So when we went out to talk to smaller businesses, the real key things for us were, whilst you can go and get bank lending for your business, it's becoming more difficult. It's the ability to get that amount of capital that can then leverage your business growth. So even if you're selling down a small portion of shares, you're selling down a portion of your business. If that means that you get enough funds in to expand the business larger, then the amount that you're left with is going to be larger. So it's getting that capital in to grow your business. Releasing value for shareholders. So a lot of people that we've spoken to have set up the businesses. They're the founders. It might be one founder. It might be a small group family that own the business. It's common that there's no plan about how to move on from that business. So they've got a very valuable business, but how do they actually realise some of that value? Now, you could sell the whole business, and there are people that will help you sell that whole business, but this is something that you have built up that you probably want to be engaged with going forwards, and therefore, how can you get value out of it without just selling the whole thing? The third one is that we'll talk a little bit about when we talk about employee share schemes, but retaining and incentivising staff is something that is becoming even more critical in the environment where we've got very low unemployment rates, and it's becoming very difficult to obtain those staff. So if you can keep hold of those key staff without having to continuously go out and recruit new people, then that's going to be very valuable to your business. And finally, I think all businesses need to be out there promoting themselves. So how do we get brand ambassadors for your business out in the public, people who are talking about your business and telling people that this is something that you want to be not just investing in, but actually using the products, using the services of. So I'll just talk a little first about what it is that I mean by liquidity. So when you think about a market, there's two basic things that a market can do. On the left-hand side here, it's capital raising. So that's when you've got shares is the simplest thing to think about, being issued by the company itself. So here, the company is raising money. It's issuing new shares, and the investor is transacting directly with the company. Now, on the right-hand side, we've got secondary market trading. So this is more commonly what you think about when you think of a stock exchange. So this is what you'd think about with an IPO. You're raising new money. And on this side, you've got where you would trade with other investors, one person buying off another. In a traditional stock exchange, this on the right-hand side happens every day. So you go along to a traditional stock exchange, and the first person comes along and says, I'd like to buy X amount of this company, and I'm prepared to pay, this is my best price. And someone else can come along immediately and say, that's great, I'll take that, I'll sell you my shares. Now, that's great for businesses that are large and have shares that are available and trading all the time. It's because in a market you can see that there's trades going through. You can always see what the fair price is because you can see that other people are trading. Now, as soon as you start doing smaller businesses, this just doesn't work, because if you have one person saying, I'm going to offer my shares for this price, then if you can't see other trades going through, they don't know that that's actually the fair price. So what the incentive is to step back and wait for other people to put in their orders. You say, well, I'm not going to show my hand. It's like a game of cards. I'm going to wait for someone else to show their hand and then decide whether or not I want to take that price. The trouble is, if everyone's doing that, no one puts any orders in and nothing trades. And this is exactly what you see on every traditional stock exchange for the smaller businesses. So if you've got a business that's perhaps under 100 million in valuation, and you list on the NZX, or any stock exchange, it's definitely nothing against the NZX, it tends to sit there, and there will be, often there's many businesses that don't have trading going through for weeks, sometimes months on end, because it's a disincentive to trade. Now, what we do instead is we have periodic auctions. And the way this works is that instead of investors coming along and saying, I want to buy or sell X amount at Y price. It batches up all the buyers and the sellers in one event. So these events normally happen over a week. And the right-hand side is just a simple example of how that looks on our website. So you come in and you read the information about the business. If you're the business, then you've released that information before the trading event. And everyone, again, can simply say, I'm prepared to buy or sell this amount of the shares. But then instead of trading immediately, everything waits until the end of that auction and everyone trades at the same price. That's calculated as the price at which the most volume would trade. So really, if you think about, for those who did first year economics, if you think about a supply and demand graph, it's where that graph crosses and everyone pays that price. Now, the reason why that's really important is because that means that you've removed the disincentive to stand back and wait. So if you're an investor, you know that if you put in a price that's actually too aggressive, then you won't have to pay that aggressive price. You pay the same as everyone else. So that's why it's actually incentivizing you to put your orders in earlier in a trading event. So this is not something new. In fact, when traditional stock exchanges all went to digital, so and New Zealand, I think that was 91, most stock exchanges didn't have, they opened at the start of a day, normal trading, and there was exactly this problem that no one knew what prices to put in at the start of a day. And so the start of day was actually generally quite disorderly trading. Practically every single stock exchange then moved to have an opening auction for this same reason, because that then removed the disincentive for those first people to put their trades in at the beginning of the day. So basically all we're doing is copying that trading mechanism. So we have a very simple exchange which allows simple batching trading at points of time, which might just be quarterly in the year. So 4 times a year, the buyers and sellers come together and you can trade that security. So that's why you have increased liquidity, because you've removed, so basically more trading going through, because you removed that disincentive to put your orders into the market. It's also simpler because if you have a look on our website, it's quite difficult to show here, but I can, if anyone's interested afterwards, we can walk you through the website. It's an incredibly simple process. So instead of having to go through a broker and engaging and talking about what type of order you want, basically all you're doing is you're going to a website, you're reading about the company that's there, and you're pushing the button that says bid, and you're saying how much you're prepared to pay for those shares, and that goes through. So if we go back to this previous slide, we do have on the market, we can facilitate both the capital raising and the secondary market trading, but these are therefore very simple in the way they're run. So what does that mean for smaller businesses? So I've just very quickly talked you through how our stock market works, but really what I want to do today is talk about what that means for your business. So before I go on to sort of the specific examples, I'd like to talk about the 3 different ways that we can help businesses. So there's basically 3 types of market that we run on Catalist. The first type, which we'll talk about when we think about employee share schemes, is a completely private market. This is something that no one else sees, so you can run this for your business and it will enable you to trade amongst anyone that you invite in, and they can trade without anyone else seeing any information. So you can release information, for instance, to employees and allow them to trade shares. We also have what we call a bespoke market, which can be open to additional wholesale investors. So this is a way that you can facilitate new people investing in your business. A good example here, we've got a business listed on the market called Mount Cook Salmon. You may see their products in the supermarkets. Now, they're not looking to raise new capital, but they've joined the market to enable new investors to come into their business. And that means that then the next time they do want to raise new capital, they've refreshed their investor pool. It means that people who are less committed to the company can gradually sell down their shares. New investors who are committed to that company can come in and invest. and then when they do want to do a capital raise down the line, it's easier. And finally, we have what we call the public market, which is where everyone can invest. So that's retail investors as well as wholesale investors. So we've got an example of a business that I'll mention in a second, which is listing shortly on our public market. But let's then move to see what the uses are of these. So I'll start with a simple one, which is to do with the private markets. So we said that one of the problems that we're solving for businesses is that incentivization and retention of employees. There's employee share schemes are a classic way of doing that. It's basically giving those employees an interest in your business. Now, traditionally, there's three broad categories, ways of doing that. First is option schemes. So that's basically, it's a piece of paper that says we promise to pay, or that you can buy this number of shares at this price at a future date, which might be, for instance, when a sale of the business happens, something like that. Now, that's great, and it actually really suits some tech businesses, startup businesses. The downside of those schemes tends to be that it's quite a valuable asset you're giving away. You're giving people the right to buy into your business, but the value that people actually ascribe to those options doesn't actually tend to be to match the value that you're giving away. It's a piece of paper that says you may get something in the future, you may not, and it tends to go in the bottom drawer, and people don't really think about it until you're coming up to an event like a trade sale or an IPO on a traditional stock market. So if the purpose is to keep people engaged, give people an alignment with the company, it hasn't really done that. They've got no skin in the game, is what is way people often talk about it. There's definitely good option schemes, but yeah, skin in the game is one thing that it doesn't happen with those option schemes. Phantom share schemes I haven't actually seen many of these in New Zealand, but they do overseas. It's quite common. Basically, it's a scheme where it's basically like a bonus scheme that you will give your employees a bonus based on the amount or the value of your shares. So if your shares increase, they get a value. Again, if they're just being given that extra money, it's just a bonus. It's not like they've actually they're invested in the company. It's not like they've got an alignment of interests where, and it's basically a promise to pay something in the future. Now, the actual share schemes are the ones that we tend to deal with more. And this is where you facilitate your employees actually buying into your shares. So they become shareholders day one. If they're paying for those shares, and Murray will talk a little bit more about the tax implications of this later, but if they're paying for those shares, whether that's through a loan that you're making to those employees, or whether it's through them actually committing funds themselves, or maybe a mixture of the two, but if they're paying for those, they've got skin in the game. They've put money into that business, and so they have an alignment of interests with you as the business owner. So not only do they get that piece of paper, the shareholder, if it's ordinary shares, they would have their voting rights, they would feel that ownership of the shares, but they actually have an alignment of interests. So we tend to actually, in practical terms and for psychological reasons, we think these schemes are actually the better schemes than option schemes. Now, even if you have the actual shares, if you can only ever get value from those shares at some point in the future, if there's an IPO or if you have to sell them back to the business, again, actually, how much are you going to value those shares? So what we can do is not only recording those schemes on the platform, but allowing them to be, if we go back to this one, allowing them to be traded on the platform. So what we do is we work with businesses who are setting up these employee share schemes. So at the point they make they issue the shares, they often will make a loan to the employee in order to fund that shares, and the employee will repay that loan over time. But then periodically, whether it's every 6 months, every quarter, or perhaps just once a year for some businesses, if it's a small number of employees, they'll allow those employees to trade amongst themselves and potentially trade as well with those employees. So if, for instance, you've got a key employee, they need to buy a new car for their daughter, or whatever they need to do to liquidate the investment, they can do that. So which actually gives them more value from those shares. So even if they never ever actually do this, the ability to do this means that those shares are valued more, which actually gives you better value out of your employee share scheme when you're selling those shares. So I'll leave Murray to talk a little bit more about employee share schemes. And the final thing that I wanted to talk about before I hand over to the others, so an example of a more of a traditional IPO, but for much smaller businesses. So we can do listings of businesses. We're targeting businesses that are anywhere between around this 6 to 60 million in market capitalisation at the point of time when they're listing. So the 20 million is about the sweet spot. But we can then, there's exemptions from the legislation which mean that it's cheaper and easier and quicker for those businesses to raise new money whilst they're listed up until they get to the stage where they're a 100 million market capitalisation company. Now, when I talk about companies, this can be products, businesses, services businesses. It can also be projects. So in particular, we've got one that is coming up, and we've got some representatives from this business here today, Black Robin, who, if you go onto our site today, you'll see there's a little bit of information about their offer, which is coming soon. And so this is just an example of how you can structure an IPO, and Claire will talk about sort of a more how you'd go about this in a second. But basically, you have a company which lists its shares, and those can be then sold down to both wholesale and retail investors, so the general public. If you remember the three different types of market we have, we can do this just to wholesale, or we can do it to wholesale and retail. It then means that investors can not only invest in those shares, but periodically they can trade them amongst themselves and again amongst the general public, which means they can get the value back for those shares. So a little bit about this particular offer. So this will be, the company will be buying a plot of land, and I'll let Jasmine and the team perhaps talk to you about it a bit later. But they'll be buying a plot of land. They will be developing a series of houses on that land. So by you investing in shares in that land, you will gain dividends throughout the period when they are developing that land, and then when the houses are on sold at the end, they will pay a final dividend and buy your shares back from you. So effectively, you're getting an equity interest in the development as it progresses, and that will be available to both wholesale and retail. There will be an offer open to wholesale investors prior to it opening to the retail investors. So I think David will send around some details after the session, and we can come back through him if you are interested in this particular one. I think he mentioned that there's quite a few people interested in property and in the group, so that's why we thought we'd use this one as an example. But yeah, this can be a property investment, or it can be any type of business. So on that note, maybe I should pass over to Claire and we'll stop for questions perhaps after all three speakers, because I think it's probably best that we can cover questions together at the end. Thanks. Oh, yes.
Right. Well, thanks, Colin. I think that's really good to get an overview of Catalist and just see how innovative that is for the SME market. And what I thought would be really useful for me to go through tonight was perhaps I'd talk to you about, say you wanted to list with Catalist or potentially any other exchange. What's the process? Like, what does it actually look like from a legal side? I'll just sort of some overview of things that we'll cover, but I just thought to give you a little bit of background about me. I've been a lawyer for 20 years, and I'm head of corporate for the national corporate team for Neave, and I've got many a client through a listing and do a lot in the capital raising space. So, If you're thinking of listing on, for example, Catalist public market, or whether it would be any other stock exchange, you need to really think about what are the key requirements to do that. And this is kind of gives you an idea of what the Catalist key requirements are. So as Colin said before, the absolute maximum market capitalisation would be 60 million. And then once you're on, you can grow to 100. But the key thing about that is actually there's no minimum as well. Typically, maybe a sweet spot's around about $20 million capitalisation, but it does mean if you have got growth plans or you want to use some of the other benefits, you can list with no minimum capitalisation. The other key thing is no minimum shareholder spread. And I've had a couple of potential listings fall over when we get to the shareholder spread because they don't quite get up to the NZX requirements, which you need over 100. So I think that's a huge benefit and breaks the barrier of being able to list. One of the other key requirements would be your governance, and it depends what stage of your business is. Catalist is making sure there's one independent director. But I think if you're at a stage where you are going into listing, you certainly should be looking at your governance, you should be looking at your structures, and making sure that you've got a really good functioning board. Right, so you've made the key requirements and you think, right, we're going to give it a go. So what do you do next? Well, always with doing any sort of listing or capital raising, it is a bit of an undertaking. And I do think this is regardless of whether this is in the retail space or the wholesale. There is a raft of regulatory requirements, and I won't bore you with all of them, but raising money from the public does have a lot of consequences under the Financial Markets Conduct Act. So the key thing is to get a good group of advisors on board really early. Typically, you would need your accountant and your lawyer, but sometimes for bigger raises, you might have a corporate finance or broker, and also sometimes a marketing person to make sure that the offer's successful. Once you've got your team on board, then you need to look at some other bits and pieces as well. I highly recommend all this preliminary work is so important. You need to look at your corporate structure, like which of you, maybe you have a group of companies, which company is going to be doing the capital raising. Perhaps you need to restructure and have a holding company with subsidiaries. A lot of sort of smaller companies might still have shareholders agreements in place or lots of different sort of classes of shares. So quite often there's quite a bit of structure work and while you're looking at your capital requirements. The key thing though with getting ready is making sure that you want to make sure that the listing's successful, the capital raising is going to be successful if you're doing it at the same time when you list, and really doing all the planning. Once you've kind of worked out your corporate structure, then I really recommend you start putting a timetable together. Does anyone have any idea typically how long sort of a listing might take place? Black Robin might have a good idea. But look, I would say a minimum of 3 months for doing a listing, but that wouldn't probably take into account if you're going to do any restructurings earlier, or if you needed sort of, or if there was some delays with producing your IM. So it is quite a plan. The company needs to be engaged and have a person in charge of it. You need to make sure that your advisors are all working together to get it across the line. So once you've decided to go ahead and you've kind of done all your preliminary work and you've got your timetable, the most crucial part of the process is getting your due diligence sorted. Basically, the way we would recommend that this is taken is you put together a due diligence committee. So the due diligence committee could be the CEO, the directors, you may have your accountant, you may have your lawyer on, or other key players. And that's really the group of people who are responsible for running the listing and putting together all the disclosure information and checking it off. I quite like to formalise due diligence. If you're going to set a committee, you might as well put a planning memorandum behind it, and you would have a look at what you're doing. You would decide whether you need perhaps a materiality threshold of what you're looking at. And the reason you do due diligence, firstly, it protects the directors on the company. It makes sure that your information memorandum is true and correct, so that you're not misleading and deceptive. And it actually provides risk mitigation if something went wrong, something with the company and something happened to the funds. So once that's all done, it's time to put your information memorandum together. Now with Catalist, by doing an information memorandum, that's actually quite a lower threshold than having to do a regulated offer on the main stock exchanges. And there's actually not a prescribed list of things that you have to include. They've just got a fundamental rule that you have to have all material information. So there's sort of no right or wrong about what's in an information memorandum, but this kind of gives you the idea of the key things that I would like to see. For example, type of investment, equity share, but you can do other types of financial products, debt securities or managed investment schemes. Background about the company, who's involved, what's the company's history. Bios of directors and senior management. And one of the key things about using the IM is the purpose. What's the purpose of the funds? And for like that Black Robin example, that's quite a good example. The purpose of those funds is for a discrete project, a property development project. But for other trading companies, it may be for general working capital, it may be for a growth plan. But if you are telling the public what you're using those funds for, you need to use those funds for that purpose. So that's a really important thing to think about. You'd have key terms of investment. If there were some rights attaching to the shares that were outside normally perhaps ordinary shares. One of the most critical elements, and I think people sort of tend to gloss over a little bit, is the risks. You want to tell what a reasonable investor expects to know. You could have a beautiful glossy document with all the upsides, but we need to tell people about the risks and what could potentially happen and go wrong. And quite often, if you've got a risk, how's the company look to mitigate it? I would suggest a business strategy of how you're going to go forward and where you're heading to, and then certainly all the contact details and who's involved. But you could imagine that this document, which I've got with 8 headings, is quite a lot of work. There's numerous iterations of it. You may want to have it typeset, making it look glossy with pictures of the project. If you're on an exchange, like for example, like Catalist, they would want to review it, so that may take quite a period of time. You might also want to think about if you're going to include financials in it, or what type of financials, and how to get that signed off. And from the due diligence committee perspective, if you are on a committee, your job is to make sure that every statement in that IM is true and correct, and that you can substantiate what you're saying, because that's what will protect you for being misleading and deceptive. And quite often, there can be quite a process to do verification. Every statement would be verified, and you would have a verification file for putting together that document. And that's the document that the due diligence committee would completely sign off on prior to listing. Sort of once you get through doing the disclosure documents, then you're kind of getting more. I make that look quite simple, don't I? But there's quite a lot of work in that line. I've called it compliance approvals, but everyone these days have to do their anti-money laundering checks on the company. And if you're going to be listing on any stock exchange, you really do need to be familiar with the listing rules. There's always different requirements in the listing rules, and the listing rules almost become, I would say, almost like part of your new constitution, because your constitution for the company can't be inconsistent with your listing rules. So when you go to do any action, you end up having to look at your listing rules and your constitution. I have to say, Colin, your rules are lovely. They're written so lovely in plain English. I think that's amazing, and I think they're really actually good rules to read. as I was reading through the other week. I've dealt with some other stock exchanges, I have to say, are not quite so easy, even though they're getting slightly better, but it's good. They're good to have a nice, clear set of rules about what you can and can't do. Probably one of the key things in the constitution that you would have to put in place would make sure that there's no preemptive rights anymore, because you're going onto a public market. There's freely change of shares. So that would be a big part of it. And then finally, if you've kind of managed to get through all that, you finally do the application to list and the issuer agreement. But the key thing, the reason you're probably doing the listing, most people, is to do a capital raise. And these are the two exemptions that Catalist has. So basically, if you want to do an offer for up to 20 million, which can be offered to retail investors, which means anybody, need to be listed for more than 3 months and done 2 public trading auctions. And I think that's a really great exemption for people to be able to raise money and raise a significant amount. If you wanted to raise, say, immediately on listing, then you're a little bit more restricted down to certain types of investors. So you could get some wholesale investors, or you can use the small offers exemption, which is only up to 2 million, or with crowdfunding and peer-to-peer lending, and that's within that first 3 months. But then over a period of time, once you've been on the exchange, you could do the 20. And I really think from a stock exchange, that is a game changer to be able to do that 20 million, because when you're doing a full regulated offer on other exchanges, it is a lot of work to get those product disclosure statements in with all the financial information. There's also some other good exemptions for the legals in the room, but is not becoming an FMC reporting entity, which means that you don't have a higher financial reporting threshold. You just your usual reporting that you do as a normal company, and you retain your takeovers code status to whether before you listed. So if you weren't a code company before you listed, you don't become one. So I think that's fantastic, and there's some really, really good exemptions of the benefit of Catalist. Colin's covered in detail about the auctions, but I suppose the difference here, just to reiterate a wee bit, is the exchange is a little bit different because you're not freely trading daily. It's within these auction times and on the auction schedule. And if you were listed and you had an auction coming up, you would be expected on your information page to make sure that your financials are up to date, you updated your information memorandum with the latest information, that nothing had changed, so that you can go into the auction. But from a compliance perspective, I mean, that is such a lower compliance requirement compared to other exchanges. And what I just thought, I haven't got a slide for, but just touch on employee share schemes, because I thought employee share schemes, Colin's covered it quite well, and the tax is probably the other big part. But I just say that we have spent a lot of time working with tax advisors putting together employee share schemes. And once the structure's decided, whether it's by loan or it's an option or whatever type, we spend a lot of time implementing the schemes. But I think on that note, I'll pass over to the expert on employee share schemes, and on the tax side is to Murray.
Thank you very much. Tax is more of a morning topic rather than afternoon, and I've never done an evening one, so bear with me. I just wanted to cover a few general comments about investing in New Zealand shares, and then I'll touch on employee shares.
Apologies, sorry.
So, clip open. Just hold it there. Oh, thank you. Great. But before I do, I just thought I'd touch on a comment as a tax advisor dealing mainly with high net worth individuals, share schemes and overseas investors. This is a common confusion point, so I just thought I'd clear it up from the start. So the vertical line here divides the immigration residence rules, which are completely different to tax residence rules on the far side. So someone could be a tax resident here in New Zealand without even living here if they have a permanent home here that they've resided in and had a connection with. So it's the consequence of being a tax resident by either meeting the 183-day rule test or having the home here is that New Zealand taxes you on your worldwide income. And for investors that have a lot of overseas companies or cash or property, that means New Zealand's going to look to tax you on those overseas assets at some point. Whereas for an investor looking to achieve permanent residence or a residence visa, the day count tests differ and are a lot less, and you may in fact not be a tax resident here, or depending on how you go about getting your residence visa for immigration purposes. So I thought I'd just touch on that, and also note that someone who is not a tax resident is only subject to New Zealand tax on the local New Zealand source income, and the tax rate may be very low. It may be as low as 2% as a levy, or it might be a withholding tax rate. Someone who comes here and lives here, either by having a home here or being here permanently in New Zealand, would normally become a transitional tax resident, which is a break that came in 2006. The Labor government brought it in at that time, which gives you a 4-year tax break to work out whether you like New Zealand or not from a tax perspective, should you restructure some of your assets, and you end up really just during that period paying New Zealand tax on your New Zealand sourced income, but also on employment income or self-employed consulting income if you have any of that. Beyond that 4-year period, you'll probably jump to a situation where you need to think about, is a tax treaty in place? For example, if a client came from Singapore or Hong Kong, or in fact with US citizens, this is a really common issue with high net worth individual US families. They come in through New Zealand after the 4 years, they realise, jeepers, I'm subject to capital gains tax in the States. They're going to tax my worldwide income every year, and now New Zealand in year 5 wants to tax my bonds, my shares, on this unrealised capital gains tax system, which I won't go into because it's a whole different presentation. And so they might look at a treaty position where they look at structuring deemed non-residents to get out of the New Zealand system. Generally, they do that by living overseas more each year than they live here. And then you get the poor person like me that is a New Zealand tax resident and pays tax on worldwide income, which eventually people that live here permanently they'll fall into that category as well. So I thought I'd just touch on that. It's a moving feast as you come in to New Zealand. So getting back to the topic that we're talking about today, which is employee share schemes, there are lots of different types of schemes. You can create one if you wish to incentivise your employees. You could customise it to look like anything you want. Obviously, it needs to be feasible for both parties, but the common ones are the share purchase plans, the option plans and the phantom plans. The things from a tax perspective to think about are firstly, when does the tax event occur? If I'm giving shares or selling shares to my employee, is there a taxable amount of employee income that's triggered from that transaction at some point? How much tax is payable, or how much income does the employee derive, if anything at all? Do I need to report that employment income as the employer? And how do I work out valuation? Because a lot of the tax rules work around what market value on the shares actually is. And that can be a really subjective feature for smaller entrepreneurial businesses because there's no market, there's no exchange. But being able to trade amongst your employees, if you have a large enough pool on your own private platform, would probably be a really good way for market value to be ascertained. So why do firms or companies offer employees equity? Often it's to incentivise the employee to get them really on board as an owner as well as an employee. The scheme might have certain KPIs where the shares transfer if the employee overperforms or performs to a certain target, or if the company performs in terms of its earnings per annum. or its share price. And so it's an alignment of the objectives of the employee and the employer. And it can also be used to retain employees. So you can use the scheme if you wish to lock them in. From a monetary perspective, it might be that the scheme itself allows them to own the shares, but only whilst they're an employee. If they leave, they've got to sell back. And generally, if we're looking at a simple system, we'd want that sell back to be at market value. So part of my job on these schemes is to talk to the owners and actually say, yeah, I know that you don't want the employees to leave and you have to buy back the shares at market price because the market's gone up like that. But if you actually have these rules, like if you leave in year 3, you only get half of market value, or if you leave in year 10, you get 90%, year 11, you get all of it, that might be good, but it has an impact on the tax timing, and it can mean the employee's stuck in this conveyor belt of taxing events or ends up paying a lot more tax on a larger capital gain. So simplicity, in my view, is best. And you can get tax advantages to both the employer and the employee. So the employee can get a tax-free capital gain on New Zealand shares. The employer, if there is some tax payable, can get a tax deduction. And also, if they're issuing shares, it's not actually cash, so it helps with working capital. If you're trying to preserve cash, then issuing shares might be a good way to do that, to remunerate people in a non-cash manner. So when we look at, I'm sorry, I'm going to bore you with the tax aspects now, I'll try to go quickly over them. When we look at how tax works on an employee share scheme, we have to look first on whether we've actually got a defined employee share scheme in front of us for tax purposes. So an employee share scheme is where shares are transferred from an employer to an employee because of the employment relationship. Sometimes it's not an employment relationship feature. I had one a few weeks ago where the company wanted the employee to invest $500,000. That employee was wealthy, decided he wanted to do that, and it was a loan, but he had the ability to buy shares for $1 to the tune of $500,000. And the company was probably a little bit insolvent, so its value was probably questionable. But that scenario wasn't because he was an employee, it was because he wanted to invest. So our conclusion on that one was the employee share scheme tax rules were not relevant. We have something called an exempt employee share scheme, and one of our guests here from Sharesies experiences a lot of those. Those are where you have larger listed companies and they offer shares, but only for a certain capped amount to all employees, including a pro rata for part-timers. So those are more common with companies like Spark or Contact Energy. For entrepreneurial businesses, we don't really see them too much because the value limit is quite constrained, and it doesn't really incentivise the key people to go further. There's not much money in it for them to sort of summarise that one. So I won't dwell on those. Employee share schemes also do not include plans. The tax rules don't apply if the employee is required to pay market value on the share scheme taxing date. And the share scheme taxing date will come to, but it's essentially when the employee owns those shares and there are no other restrictions or fishhooks impacting on how that employee can own or maybe have to sell back those shares at a future date. So that's actually, this one here is one that I focus on quite a bit when I'm trying to have a simple scheme, when I'm talking with the client and with the legal team that's going to end up going ahead and drafting the agreement. And there's another exclusion where the employee has to put the shares at risk, so there's no underwrite. If the shares go down, the employer's not going to protect them. Those are probably for more mature companies where the price is quite high and there might be a loan element to help the employee buy in. But there are further other restrictions where it doesn't relate to schemes. The concession doesn't apply if there was a loan or if there was a bonus paid. So it's quite a limited concession in my view. So once you've actually given the employee the ability to acquire the shares, when is their taxing date? And that's the first date when the shares are held for the benefit of the employee. The reason we use that phrase is a lot of these schemes actually have employee share trusts that are administering all the custodial elements of the scheme. You've got to pay people to do that for you. They've got to deal with all the headaches. If you've got a large employee team, there could be a lot of work involved there. If dividends are coming out, you need to know who they're going to. And so they like to consolidate the shares in the trust because it's one point. They often give the trustee the right to vote on behalf of all the employee share scheme owners. In the example we've talked about here or seen tonight with the private trading, that would, I presume, be done within that platform as well. So that would take that job away entirely. The other factor is that there can be no material risk that there's a requirement for the employee to transfer, which might be to sell back or cancel the shares for other than market value. So as the price goes up, the employee is entitled to market value. As the price goes down, the employee suffers market value if it's dropping. So as long as there's no rules changing that relationship or changing that outcome, then you've got your share scheme taxing date. And the reason that that's important is that determines when the employee has employment income. And often when you're dealing with companies that are going up in value, of course the employee wants to have that taxing date early. If it happens at the end, they might have a large tax bill, they'll also have a large capital gain. What you don't want, which does happen unfortunately, is for it to go like this, the employee has a taxing date at that point and then the shares go down, particularly if they haven't paid the tax bill before it goes down and they've got nothing to sell or less value. So it can be, employees need to be aware when they go into these schemes that they're bearing a lot more risk than they normally would, and that's where the legal teams come in, and the share scheme documentation is quite robust and detailed, can be dozens and dozens of pages, if not hundreds in some cases. Now the rules are a lot more complex that I'm talking about tonight, and I'm going to simplify things even further. So this is almost a ridiculous example of a share scheme, although the actual numbers involved actually, I reminded myself once I wrote it that I had one example where the gain was even higher than this over a relatively short period of time. So in this example we have Jack, and he's entrepreneurial. He's created a startup software company. It's grown to 25 employees over the first few years, or first 5-10 years, and 1,500 customers. But he's sort of at that point where he's thinking, well, if I grow further, I'll be attractive to an overseas acquirer, or maybe a consolidator, or maybe I'll just end up building up this massive revenue and I'll have great dividends. So he's decided at this point to offer his top five software developers some equity in the company, and his top 3 marketing managers, because they're really important to secure that customer base. So he's offered each person 200 shares at a 50% discount. And in this example, if we say the shares are worth $4 each at this point, and he said, you can buy those, but not until 2 years' time. So he's trying to create a lock-in and saying you can have them for $4, that's what they're worth today, but I'm going to allow you to pay only $2. And so they're all incentivized to keep going. And so we then have to look at the tax issues. So in 2 years' time, the employees all decide, yeah, I really want to buy those shares. I want them. I've been offered them. They are mine. I've got to pay they're worth $4. And if the company's sort of bubbled along and it's still worth about $4 at that time, they only have to pay $2 per share, but they've got effectively a 50% discount. So for 200 shares at $2 a share, it's only $400. It's not going to cripple them financially. That might be a little bit ridiculous, that side of the example. The company at that point has to report, it doesn't have to pay the tax, but it has to report that there's been some employment income, $400 per employee, and that goes into the company's PAYE returns. But the company can elect to pay the tax if it wants to, and that creates a cash flow issue, particularly with big numbers. But it doesn't have to. So if it decides it's not going to pay the tax, then the employees all have to file tax returns and pay their own tax. And often when we've got schemes where they're getting share offers every year, they might have different tranches and different employment amounts. So all of a sudden these employees become provisional taxpayers 3 times a year, terminal taxpayers, and they start going, oh my gosh, I'm not focused on my job. I've got that tax accountant ringing me up saying I haven't paid enough tax and I've got to find the money. And I'm paying my mortgage, buying the groceries and filling the car up, and I've got no cash yet because this hasn't paid a dividend. Anyway, so it's a bit of sometimes the employer might say, well, you can sell some of the shares, or we'll say, instead of 200, take 150 and we'll use the 50 that you don't take for the PAYE and we'll do it for you. So that's a point of negotiation as well. If the employees are paying the tax, they're going to have cash flow from somewhere else. The company, to actually fund their own tax bill, the company will be entitled to the tax deduction equal to the amount of employee income. But for startups, if they're not in a tax-paying position, the company itself, they don't really want another tax deduction because they're not paying tax anyway. They're carrying forward losses each year, but they'll be able to carry forward that deduction in their loss balance. If they're paying lots of tax, then it's great because particularly if they've issued shares to the employee at a discount to market value, they'll get a tax deduction that didn't actually cost them any cash. So in some examples, if it's a really big, for a senior executive that they're really trying to retain, they might take the tax deduction and then say, well, that saved us $200,000 in tax. We're going to pay that executive a $200,000 bonus, which is taxable, and he or she will get, say, they'll be on the top 39% rate probably. They'll get 61% of that. That'll help them pay their tax bill or help them fund the share purchase. So you can be creative in any way that you want to. When you talk to your advisors, they'll come up with these ideas. 5 years later, in this example, the company's subject to a market buyout at $5,000 per share. So the employees who still own their original 200 shares now have shares worth $1 million each. The actual cost was more in this example, in the client example I was thinking of, but the actual numbers of the gain for the employees are actually understated in this example. And part of that buyout requires the employees to sell their shares. So part of their share agreement and their constitution, probably their shareholders agreement, requires them to have drag-along, tag-along rights, no doubt. So they've sold out, they've come away with a gain of almost $1 million each. In New Zealand, that's probably going to be a tax-free capital gain to the employee because they've actually received these shares as part of their employment package. The things each employee needs to bear in mind would be, is there a risk that they're acquiring the shares for the main purpose of resale, or did they acquire them as part of a business of trading in shares or some other scheme or arrangement? Now, I'm yet to find someone who puts their hand up to say that that was me and pays tax on the capital gain. Most of them would be investing for long-term on the long-term journey and acquire those shares passively as by virtue of that employment agreement and share scheme agreement. I'll just very quickly, just this one slide, if Jack instead had said to the employees, I'll give you the option to buy the shares in the future for $2, and in the future they were worth $4 at that time, and the employee exercised the option and took the shares, they'd have exactly the same amount of employment income and the same tax event. So option schemes can be good and bad. For example, if the option scheme has a really long vesting period, then the price of the shares might be really high when the employee becomes the beneficial owner of the share, and they'll pay a lot more tax. On the other hand, if the share price goes down, it's an opportunity to buy, but not an obligation usually. So there's some element of choice. Other commercial considerations, the market value is key for those tax calculations. So how do we get a market valuation? Well, the worst outcome is going and getting a financial advisory expert or a valuation partner to go and do cost-wise it's the worst, precision-wise it's probably the best. You'd get a valuation report, but that can cost you tens of thousands of dollars or more. So if you've got a really active share scheme that's having transactions all the time, you don't want to be getting a valuation report every month. That would just be crippling financially. Some schemes have formula within them, within the shareholders' agreement, to say that the share price is worth 4, 5, 10 times EBITDA, and unless the directors feel that's not a proxy for market valuation. So there's a bit of looseness around it. Other proxies that you can use is recent capital raises. So if there's a third party coming in and taking, investing 10 million into the company and getting a certain number of shares, that's probably a good proxy for market value per share. The trading between employees, which I've only recently seen this year actually, that I'm aware of one with about 400 employees and they have trading windows, and that is a good proxy, and it allows liquidity as well for the employee shareholders and the larger investors. And the trading window's also quite good because it means you're not doing it the whole time, so it can reduce cost. From an agreement point of view, you're going to have the full range of agreements associated with these types of schemes. So you need to get your legal work done thoroughly, and the legal and tax and the commercial driver to what the business wants to achieve need to all be aligned. And so the final document, if it doesn't do those things, you might have some unexpected tax outcomes. So it needs to be thoroughly looked at. It does take a bit of time. And I've talked about share scheme trustees. They're sort of ignored for tax purposes. And the costs of running that scheme are deductible to the employer company if it is an employee share scheme. If you are the main owner of the company, then selling your shares, you might do an off-market transaction. The company itself, if you wanted to take equity out, you could do a share buyback under New Zealand rules. So if you have a share buyback and it's pro rata across all shareholders and it meets certain minimum buyback thresholds, you can get money back out of your company that way. It might be via an IPO where you've got liquidity on the market to buy and sell your shares after that, or it could be an on-market transaction if you're already listed. In many cases, entrepreneurial businesses end up being sold not at a share level, but as a business asset acquisition. So an example might be if I have a company and I'm a property developer, I've bought a really good piece of land, I could build 1,000 residential homes on that land. I go through my lawyers or my resource consent people and I apply to council to have it rezoned, and certain features changed around in the district plan. Council objects, I then go to court, council walks away generally, I get what I want as long as it's realistic, and all of a sudden that piece of land is worth up here. Now, I may not want to be the developer, so my company itself sells the land and I've got a huge capital gain sitting in my company. A really important thing under New Zealand tax rules is that when that capital gain is in your company, you can't just take it out unless it's a look-through company, which may or may not be that relevant to this audience. But if it's a normal standard New Zealand company, you're going to have to either reinvest that capital gain within the company or think about liquidating it. And so that's a little bit of a trap. Particularly if you have a holding company above it and 5 subsidiaries that are operating, and this one here's the one that you've made the capital gain, you've still got the gain trapped at your holding company's level. So you may have to restructure your entire group, which is a really common issue for tax advisors. And my final comments would be that for employee share schemes, the commercial drivers that you want to achieve, the legal and tax issues, they can become really complex. If you keep it simple, it's going to save you money, it'll drive efficiency, and definitely take advice before offering equity, because it might be the worst thing you ever do. With the example of the phantom schemes that we talked about before, that's just a bonus that reflects the share price growth. So it might say you're entitled to 100 phantom shares worth $2. In 2 years' time, if they're worth 10, you'll get paid $8 a share as a cash bonus. The employee never took equity. You were never diluted as a shareholder, and you never had to deal with them at the shareholder table. So everyone will be different, but take advice is my final comment. I have 2 of my colleagues at the back, Alicia and Roz, and if you have any questions at the end, just feel free to ask them or myself, but thank you for your time.